All right, and we are live. Hello, everyone, and welcome to our latest Lodgify webinar. My name is Mikkel Radich, and I'm a content marketing specialist here at Lodgify. And I want to start out by just giving everyone a very big thank you for calling in. I always love to see where everyone's calling in from. So if you want to take a second to put it in the chat, I'm sure we've got people from all over the US. And yeah, thanks for taking time out of your busy day, especially during what I know is ramping up to be high season for most of you guys. So yeah, appreciate you being here. And as we are all well aware, there's been a lot of uncertainty in the US recently. So I'm very excited to have with me here today John Ann from TechTape and Melanie Brown from Key Data to kind of look at the numbers, discuss the situation, and see what we all can do to safeguard our revenue in the current market. So thank you, Melanie and John, for being here. Do you want to go ahead and introduce yourselves?
Melanie, why don't you start?
Okay.
Sure. Okay. I was like, I don't know who's going first here. Yeah, thanks for the introduction, Mikhail. Excited to be here. I'm Melanie. I lead the data analytics and engineering teams at Key Data. So Key Data tracks trends in the vacation rental space. We work with professional property managers all around the world, give you information about what's happening in your own inventory, and then compare that to the market as well. So I do a lot of these presentations. My wonderful team of analysts builds a lot of them. We try to keep a really close eye on everything that's happening in the market and help people figure out how to respond to that. So excited to be here today to do a little bit of that with everybody here.
Amazing. Thank you, Melanie. You want to go ahead, John?
Yeah, and just a quick introduction for myself. My name is John An. I'm the founder and CEO of TechTape. We provide tech-enabled revenue management services for the short-term rental industry. And so we're not software, but we use a lot of software and technology to tailor a revenue strategy that fits your portfolio's needs. And I'm really excited to be presenting with Melanie and Raquel today, and hopefully we can add some value.
Definitely. Yeah. And I should mention that both Key Data and, as of yesterday, TechTape are Lodgify partners. So we integrate them with the Lodgify software. So it's great to partner with you guys in general and today on the webinar. And yeah, they've got a great presentation for us today, and I'll be handing it over to them in just a couple minutes to get started. But first things first, a couple things for you all to keep in mind. We cannot hear you. Everyone is muted, but we can see the chat. So if you've got comments or questions, go ahead and put them in the chat on the right side of the screen there. Now, if you can't hear us, that is a problem. If you see a blue button on your screen that says tap to unmute sound, go ahead and give that a click. That'll solve the issue. Other things to try, turn up your audio if it's down low, and then sometimes just refreshing the page will help as well. And then because we get this question quite a lot, yes, the webinar recording will be sent out tomorrow. So if you missed something or you got to hop off early for some reason, you'll get the full recording. You can reference it whenever you want. Okay, webinar structure. What can you expect from this? I'm going to start us off with a brief introduction to Lodgify for any of you who aren't familiar with us yet. Then I'll be turning it over to Melanie. She's got some great metrics that kind of just paint a picture of the current situation in the US right now, as well as some strategies to help you all take advantage of that situation. And then John will be wrapping us up with some specific revenue performance case studies. And then as always, we'll end the webinar with a Q&A session. So again, if you guys have any questions right off the bat, or if anything occurs to you, go ahead and put them in the chat, and we'll try and get through as many as we can at the end of the webinar. Okay, what is Lodgify? We are a vacation rental management software that helps you manage, automate, and grow your short-term rentals. And our goal is really to help you maximize the potential of your property and take full control of your business. And this applies to hosts as well as property managers that manage multiple units. And we do this with what you could really call an all-in-one ecosystem. We've got a lot of features. I won't get into all of them today, but just to give you kind of a brief overview of the main offerings, it really starts with our website builder. We offer a website builder as well as a booking widget. So you can use either essentially to start accepting direct bookings for your website. If you don't have a website at all yet, you can use our our website builder to get one up and running. The main thing to know about this is that you don't need to have any technical skills at all. No know-how, like you don't need to be a website builder to make this happen. I promise you can have your website up and running in really just a few minutes with basic functionality. Now, if you already have a website set up for your business, but it can't accept direct bookings, you can also use our booking widget to implement that functionality. And in this case, it really is just a copy and paste of code in the back end. The next most important feature to be aware of is our channel manager, and you can use this to sync your calendars, bookings, rates, all of the important information across your direct booking website and then any other site you list on, so like Airbnb, Vrbo, Booking, etc. And then the last thing I'll touch on is our property management software. Now, this has many, many features, but they all have the goal of helping you automate your business to help save time and just make sure you don't miss anything. So an example of that is our automated custom messaging templates, which you could set up to automate things like making sure people receive a message when they book with all the details they need, right? So you don't have to worry about it. You don't have to worry about forgetting it, and you don't have to spend the time manually writing it. Since we are talking about staying profitable in an uncertain market, I'll also mention that Lodgify offers dynamic pricing. So if you want to work on optimizing your pricing strategy, our dynamic pricing feature can help you do that. And then, of course, we also integrate with a marketplace of third-party apps. I think we've got around 40 of them, and those also, of course, include TechTape and Key Data. So if there's something you want to do with Lodgify that we can't, that we don't offer, chances are we integrate with someone who does. If you haven't tried Lodgify yet, keep in mind that we do offer a free 7-day trial, so you can give us a try whenever you want. There's a link there on the screen. There's also a button at the bottom of the screen that says try Lodgify for free. I encourage you to do that if you haven't tried us yet. And then last thing from me, just want to let you know we do have another webinar coming up on July 9th with Arthur Coker from StayFi and Carrie Gibson from Shelley's Huga. This one will be on how to build a direct booking powerhouse. So you can register for that webinar either using the QR code on the screen there, and then I'll also put the link in the chat for you. And that is it from me. So I will hand it over to you, Melanie.
Okay, thanks for the handoff, Mikal. It's really amazing how much the tech stack for property managers has shrunk in the last 10 years is one thing I noticed. 10 years ago, everybody on the call would have had to have 18 different systems to do everything you just mentioned. So pretty cool. And then, yeah, if you need more insights into property performance or market performance data, Key Data is one of those apps that you can activate. And then we pull data, your reservation and property data directly from Lodgify, which is how Key Data gets all of our data. We work, again, with property managers around the world through those direct PMS integrations. We also scrape Airbnb and Vrbo just to get a holistic look in the marketplace. But all the data I'm presenting today is directly from professional property managers in the US. And again, that direct source data. We're going to keep it pretty high level for a lot of these trends today. And then John's going to come on with some recommendations and kind of case studies. We're going to look at kind of the main metrics we keep an eye on. I'll try to talk everybody through what those metrics are, how they're calculated, and then what they mean for your business. But definitely it's been a wild ride the past, 5 years in the U.S. vacation rental industry, and it just continues to get interesting. And so excited to share kind of where things stand and some ideas about where they might be going for the rest of the year. And then, yes, feel free to throw anything in the chat. I'm happy to answer questions as I go, especially if you're like, you didn't explain that well enough. So just let me know. Our paid occupancy rate, or your paid occupancy rate, is the number of guest nights booked out of nights during that period. So just how full were your units. You're going to see this chart a few different times, so let me talk you through it. On the left side here, we've got annual totals for 2023 in the US versus 2024 in orange. And then we've got some forward-looking data starting to get a little bit into that crystal ball, looking at what's on the books for the rest of the year and the year so far. for both 2025 and then 24 as of June 15th last year as well. So really apples to apples year over year. So last year, we continued to see a little bit of occupancy softness in the US. So down just 1% in 24 compared to 2023. Pacing for the rest of the year, though, so what's on the books already, our occupancy rate is flat to 2024, which is really encouraging at this point. There has been a lot of uncertainty, speculation about kind of the economy and the impact that would have on vacation rentals, and administration changes and international travel and all of that stuff. I think especially as we start to look at this monthly chart here on the right. So this is, again, 25 in navy blue compared to 2024 on the books in that dark orange. The other weird dynamic we had this spring is that Easter shifted from March in 2024 back to April in 2025. And March and April is when things started to get real interested in the U.S. economy and politics as well. And so I know I was freaking out a little bit in March. Like bookings had slowed down. We weren't seeing as much advanced pickup. And everybody was kind of worried and wondering, myself included, what was going on and what would the rest of the year look like. At this point, the rest of the year looks pretty healthy. We're a couple percentage points behind. We've seen more last minute bookings. We expect to pick that up. But really in March of April this year, we just had the perfect storm of a major holiday changing from month to month and quarter to quarter on a year-over-year basis, combined with a lot of economic uncertainty. So we were pacing behind for the year, through March and April, but in May and June, we've started to see booking activity really pick up. And we're pacing fairly well for the rest of the year, at least at a national level. And so even for the year to date, we ended up with the occupancy rate. So that's year to date on the left side of this chart here with 24 in orange and 25 in blue. We ended up with an occupancy rate that was flat to last year as all of those kind of last minute bookings came in. We're pacing slightly behind for the rest of the year. Again, expecting at this point that a lot of those last minute bookings will kind of bump us up and we'll continue to get those reservations being made. But again, I think this is good news that, overall for the U.S. industry, demand has stayed fairly strong. People are continuing to book travel and definitely a little bit of headwinds, but we have not seen a major decline in the occupancy rate for the U.S. this year thus far. Rate's a little bit of a similar story. So the average daily rate is the average amount of rent paid per guest night. Last year, again, 24 ended up just $1 down, just like we were one occupancy point behind. 2023 pacing, we're actually $1 ahead of last year. So seeing mostly flat rates, not a ton of pricing power right now. Again, on a monthly basis, we saw a little bit of a rate decline in March because of that Easter holiday shift. And then April rates ended up pretty flat to last year with some May growth. The shaded orange box there is where we ended up last year as reservations continued to be made. So people are not done booking July. All of the people who have booked for July thus far, or most of the people, have booked pretty expensive, longer stays. And so as people make those shorter last minute reservations, we'll start to see rates come down. And then we're seeing pretty high prices on the books for the end of the year so far, which is a little concerning. We want to make sure that those rates are getting adjusted, a little further in advance, that we're keeping in mind that consumers and travelers are price sensitive right now. And it'd be nice to go ahead and start getting some of that fall and holiday pickup, but your rates have to be dialed in to make that possible. So again, recapping rates, year to date, we've been down about 3%. Rest of year, we're pacing higher than last year, up about 2%. Again, just to really hammer that home, we've been seeing that trend for a couple years now, where further out pace is higher than last year. And then as people book those cheaper last minute stays, we're coming in kind of just behind the prior year. So again, would love to encourage people, go ahead and start looking at your forward-looking rates. Don't rely too heavily on those last-minute cheaper reservations. And then also just keep in mind as we look at the future pacing data for things like prices, that there's a ton of time ton of room for that to change. And so would expect those prices to end up fairly in line with last year, even though currently they're pacing ahead. So lots of pricing dynamics to keep an eye on as you continue to price those rentals. RevPAR is a little tricky, but really not that tricky. It is revenue per available property. It is the average amount of rent collected per night, whether that rental was booked or unbooked. So you're going to take all of your revenue across a year and average it out by night. Again, regardless of whether there was a guest staying in the unit or not. We love RevPAR because it tells us whether your occupancy and rate are balanced or not. So often if your occupancy rate is really, really high, I think we'll look at this with John a little bit too, it probably means you're priced a little too low. It also means you're getting a lot of wear and tear on your property. There are people banging their suitcases against walls every single weekend or every single day. You've got a lot of cleaning turnover often to deal with. And so it can actually be a little bit better to, increase your rates a little bit, again, in line with the market. Don't skyrocket them and not be fully occupied all the time. Similarly, rates are great, but people have to be booking them. And so RevPAR is really that balance between your ADR or your price and your number of guests and occupancy. So last year, 24, we did see revenues continue to trend downward for the, third year in a row or so at this point. Really driven a lot by excess supply in a lot of markets. So people have a ton of choices. We've also, we'll look at this data here in a second. We've had a lot of people traveling overseas and not as many people coming back. So some demand patterns as well. And so RevPAR last year in 24 finished, about 4% lower than in 2023. 25 at this point, pacing flat to last year. Again, with that exception of Easter. So March was a little bit lower. April was a little bit higher. We're pacing a little bit behind for the rest of the year, but still pretty close. And then notable, summer continues to be that peak season in the U.S., but lots of markets have really solid shoulder season demand now too. And so don't put all your eggs in the July basket. Make sure you're looking at kind of optimizing August and September and picking up on some of that low season demand too, to increase your kind of annual amount of revenue generated. So again, year to date thus far, we've been slightly lower than last year. So generating an average of $93 in rent per night compared to 96% or $96 last year, really driven by lower rates for the year to date. Rest of year, again, we're, pacing a little bit behind, mostly driven by lower occupancy. And so would continue to encourage people to keep those rates dialed in. And then also probably a great time to look at your distribution as well, right? With, demand a little bit different than it has been at other points in the year or other, years in the last 6 years. Really great time to make sure your properties are listed on multiple OTAs and a direct website so you can capture as much demand as possible. Regionally, though, there's always variation, right? A lot of you are probably looking at that U.S. market data like, oh man, that's not what's happening for me. And it's because there's just, again, so much variation across markets. So this is just Q3 RevPAR. Again, Q3 in particular, we're pacing about 6% down at this point, expecting to see that come up with some last minute bookings. So $90 a night. Regionally, though, we're seeing a ton of variation. So Hawaii has had a little bit of a rough go over it the last 5 years between, just delayed COVID recovery, really a heavy reliance on international travel, and the fires on Maui a couple of years ago. We're starting to see some growth in the Hawaii market again, which is really encouraging. So their summer RevPAR up 9%. A lot of these markets, however, not doing quite as well. So Mid-Atlantic states down 7%, similar to kind of Southeast U.S. overall, Southwest and the Western U.S. Seeing a little bit of growth in Rocky Mountains up 1%. And then Midwest and New England are fairly flat. So again, really important to keep an eye on your regional data and your local market data as well. And then we also like to segment at key data by destination type because there tends to be a lot of variation there as well. So this is just US broken down by destination type. Attractions and resorts are going to pull in things like Orlando. So, a lot of reliance on Disney and other theme parks there. Coachella Valley, for example, which it's a lot of, spas and resorts, are struggling a little bit on a year-over-year basis, with Q3 RevPARs down 9% compared to Q3 last year. And then urban, cities down about 9% year over year. Lots of regulation continuing to happen in US city markets. And again, we'll look at this, but that reliance on international travel and business and corporate and government travel hurting those city destinations as well. But we see some growth, encouragingly in these lake and national park gateway markets. So people, in mountains flat year over year, people continuing to seek out those more rural destinations that we all have talked about for 5 years in a row now, post-COVID, looking for some of those cheaper, destinations that are doing pretty well on a year-over-year basis. Okay. I've alluded to these a little bit, but wanted to leave everybody with two major trends to keep in mind as we continue to look at kind of the rest of 2025. The first is domestic versus international travel. Lots going on this chart. This is data from the U.S. International Trade Administration. They track foreign citizens' arrivals to the U.S. This is green. And then U.S. citizen departures from the U.S. in orange. This is all indexed as the percent change from 2019. So you can see both of those fell off a cliff to practically nothing for a lot of 2020 and then started to come back. In 21, 22, we saw more U.S. citizens traveling overseas. That came back a little faster. Exchange rates were pretty favorable. Travel restrictions were pretty favorable. Since then, we've been hanging out, 20 to 25% more Americans leaving the U.S. to stay elsewhere than they were pre-pandemic. So international travel by Americans has really exploded. Conversely, foreign citizen departures from the U.S. or to the U.S. and green here, still not back to where they were pre-pandemic. So hanging out, negative 10% or so. So what that means for U.S. vacation rentals is you've got less demand by Americans looking to stay here, and then also less demand by international visitors coming back to your destination. So definitely a tough trade imbalance there. We also saw a bit of a drop in April. So April, we had fewer foreign citizens arrivals to the U.S. than we were kind of trending at before, and then fewer people departing. It looks like some of that was probably Easter driven on top of political and economic uncertainty, but starting to bounce back a little bit. But still a really hard balance here. We've especially seen a big decline in Canadian stays. I know I'm throwing a ton of data in front of all of you. We'll share these slides. Send me any questions. But let me just talk through this. We've got 34% fewer Canadians traveling to the U.S. than we did at this time last year. It's really going to impact a lot of these snowbird markets this winter if that stays true too. But for a lot of destinations in the U.S., Canadians are their top, foreign citizens. And so this could have big impacts for you guys depending on where you're located. But important to know that boycott is still impacting booking activity. But it's going to impact everybody differently. This chart shows the percent of 2024 demand that came from international travelers by market. You'll see a lot of these destinations, these classic kind of leisure beach mountain ski markets are not heavily dependent on international travelers. So 30A on the panhandle of Florida, for example, only got 1% of their travel demand in 2024 from international visitors. 1% for Lake Tahoe, 3% for Myrtle Beach, 3% from Western Colorado. As we start to get into more urban or, international destination markets, that's going to change. So Hawaii, about 12% of their demand last year was from international. Orlando, 19%, and Washington, D.C., 23%. And so again, we were just looking at that RevPAR pacing for urban and resort, really struggling on a year-over-year basis. And a lot of that is because of this decline in international demand. Most people still get to a vacation rental by driving, right? They're packing up their kids, their dog, they're loading up the minivan, and they're driving to you. And so a great time to focus on those drive to destinations, right? What are the cities and feeder markets within a reasonable drive, and how can you get marketing and messaging in front of them to really lean into that drive to and rely a little bit less on fly to or international travel. Okay, and then second major trend, we do see people to continue to book, closer to arrival and for more last minute, or excuse me, shorter stays. And so important to keep that in mind with your pricing and messaging as well. This chart is just year to date for 2025 and shows, based on the stay length category on the left, how much demand is generated in each of those categories, and then what the year-over-year change is. So most people continue to to book those 3 to 5 day stays. So that was about half of all demand, or half of all stays for the year to date were 3 to 5 days, down slightly on a year-over-year basis. The next biggest category at 31% is 1 to 2 day stays, which we're actually seeing more of on a year-over-year basis. So people may be booking a 2-night weekend stay instead of a 3-night weekend stay as a way to save a little bit of money. Similarly, we're seeing a decline in that classic week-long stay. So, 14% of reservations, but down 1 percentage point compared to last year. So we're seeing people migrate, and we have been seeing that trend for a few years, from that classic week-long stay down to, 3 to 5 days, or from 3 days down to 2 days. Great way to save some money for them, right? Is to book one fewer nights. But it probably means you got to keep an eye on your destination's kind of trends in terms of stay length. Keep an eye on what your competitors are doing. If you still only allow Saturday to Saturday check-ins, and you're like, why is my occupancy low for the summer? That may be something to look at, right? Or other people in your market still only allowing weekend stays. Some places like the Outer Banks of North Carolina, though, like Saturday to Saturday is king during peak season. So probably not worth messing with there. And then similarly, we're seeing people move towards a shorter booking window. So now we've got, year to date for 25 in blue, 24 in orange by stay length category on the top. Key headline here is we're seeing a pretty big increase in the number of people booking less than 14 days from arrival. So waiting until 2 weeks out from their trip to book that. We're seeing a little bit of an increase in that 15 to 29 day stay as well. And then fewer people booking further in advance. But we do continue to see people are either booking more kind of last minute or, 60 plus days out are our biggest chunks there. So again, that's stressful to have 38% of your demand come in 2 weeks from arrival. So go ahead and start looking, 60, 90, 120 days out. Is your pricing dialed in? How can you pick up some of those longer bookings or longer booking windows that come in and book, more expensive, longer stays further in advance? I think as an industry, we've really trained our guests that we're going to slash prices at the last minute. So you might as well wait and book a week out. With occupancy lower, our guests know they can do that too. And so, keep an eye on your rates throughout that booking window. So that way we're not all panicking 7 days out from a stay. So quick wrap up, and then I'll pass the floor to John. It's gonna, success in 2025 is gonna depend on you using data sources like this and making informed strategy decisions about how to manage your portfolio, how to, encourage people to book longer stays at higher rates further in advance. Keep an eye on these metrics for yourself. So occupancy rates, revenue per available rental, they're all, relatively flat year over year, but a lot of room for that to change. And then we are seeing booking windows and stay length shortening. And so really important, again, to keep an eye on that. Make sure you know what's happening in your own local market, and make some strategy decisions on how you want to manage your rentals accordingly. People are welcome to reach out to me by email, and then lots more information at keydatadashboard.com if you're like, man, I should really have more of this data in front of me on a regular basis. But thanks, everybody. John, I'll pass it to you.
Thanks so much, Melanie.
Right. Go ahead, Mikkel.
No, I was just going to say thank you. And I can go ahead and put your email in the chat in case anyone wants to keep that for later. It was melanie@keydata.com.
Yeah, I'll drop it in there. I got it.
Okay,
I'll
awesome.
throw our
Thank you.
website in there too. Thank you.
All right. I will share my screen and go to full presentation mode. Can everyone see my full screen?
Yep, looks perfect.
Hello?
Yep, we can see you and hear you.
John, we got you. I know you were having
Oh,
trouble hearing Mikkel earlier. Yeah, we
okay.
got you sliding in your voice.
Okay. I'm gonna go back to full screen. It seems like I'm having some audio issues, but I'll just keep going with it. Um, okay. So, thank you, Melanie. I think that was really great. That was very helpful to kind of get an understanding of overall what's going on in the US. Um, what I'm going to do is kind of go through a couple case studies, but before I do that, well, the case studies will really be so that we could see how the very local, nuanced activity is informing revenue strategies in different markets. But before I do that, I just want to share kind of some high-level key concepts about revenue management and pricing, and so that we're all on the same page. Um, just for reference, TechTape, we do provide revenue management services all around the world. Our market is primarily in the US, but we work in all different types of markets. And so, as I was listening to Melanie, it was very evident how all the different markets are behaving slightly differently. What I want to start off by is just kind of try to explain revenue management versus pricing. So I'm using soccer or uh, European football as an example. Um, it could seem like revenue management is just about pricing, just playing around with pricing and maybe length of stay and fiddling around with that. And that would be kind of equivalent to saying that soccer is just taking a ball and kicking it around. And, by doing that, you're actually playing soccer. And while kicking the ball is an important skill, that's really not the game of soccer, right? The game of soccer actually needs strategy, right? You need to have a strategy on how you're going to play, and how your teammates are going to play. That could be the market and whatnot, and have kind of a understanding of how that game is going to play. So the strategy is set. But then once you have the strategy set, you actually have to execute it on the field, right? So while you're playing the game, a key player might get a yellow card, and then now that player is no longer available. So then you have to shift your strategy so that you could still execute. You might have an injury on your team, but you need to be nimble and adjust to what's going on in the field. And that would be kind of equivalent to what's going on in the marketplace, your local marketplace. And so that's how you need to have that strategy, but you also need to be nimble and kind of switching your strategy in order to execute it. And that's how you end up winning the World Cup, right? And so that's how it all comes together. And the data, the information is really part of that strategy and execution piece of understanding what's going on and how you should be responding. So to kind of put that at a high level, our kind of ethos is that data informs the decisions that we make, but the data does not drive them. We don't chase what's going on in the market because that's what the data is telling us, but we're informed by understanding what's going on in the market. The reason why I have this image on the slide here is trying to make decisions by looking at the historic data is kind of like trying to drive while looking in the rearview mirror. And yes, the rearview mirror, that's the road that you passed, and you did a wonderful job of not hitting anything. But it's really what's coming out ahead that's up front that's really important. And so relying on especially historic data for a lot of your decisions oftentimes does not result in the best outcomes. And if you ever invested in any securities or anything, there's always that saying, past performance does not indicate future results. And that's especially true in revenue management for the short-term rental industry. All right, so I'm gonna go through three markets, just to kind of see, and these are markets where we have portfolios that we're managing. And so the first one is Honolulu, Hawaii, and Melanie had mentioned, quite a bit about Hawaii in her presentation. So Waikiki and Hawaii, that's the market that we're focusing on, and we're looking at two-bedroom, two-bath condos. Um, One thing that is really important to note, I know Melanie had mentioned how Hawaii was recovering, and this year over year, where Hawaii is about 9% ahead. Um, Last year, though, I think Hawaii was considered to be like 20 or 25% behind, and it was primarily due to the wildfires on Maui. And so Maui's wildfire had a big impact on the overall, state. However, the individual markets, Oahu, where Honolulu is, was actually pretty stable last year. And so if you look at the occupancy for this two-bedroom, two-bath portfolio, let me just explain how these graphs work because I'm going to have a whole bunch of these. So the dark blue lines are the actual portfolio's performance. The pink lines are what the market of similar two-bedroom, two-bath condos in that area did. And obviously, this is looking over multiple years. So if you look at the occupancy last year, the market was at around over the period of January through June, which is kind of what we're looking at for this year so far. The market occupancy was at around 82%. Um, our portfolio was at around 86%, so slightly higher, not too dramatically higher. And then this year, what we're seeing in terms of the market occupancy, it dropped by a percentage point, so 81%. Uh, and we increased it by slightly by 1% to 87%. So that's what happened in terms of occupancy. Now, when we look at average daily rates, so the rates that people actually booked at, not what we were just advertised on, um, the slightly higher occupancy that the portfolio achieved was at the expense or was due to a slightly lower or meaningfully lower ADR, average daily rate. And so more or less it stayed more or less with the market, but slightly below. And then towards the end of the year, it picked up. And so that was the average daily rate. This year, what we're seeing is there was a lot of volatility, yet the market picked up, right? The market's average daily rate picked up to 522 from 511 last year. But we did push the ADR slightly higher. And so we were able to balance out between, still get the higher occupancy while pushing the rates up higher. So Melanie had mentioned how RevPAR is really what tells you how much money, you're making. So again, in line with what Melanie was saying, the market actually in Hawaii, it grew slightly last year. But in terms of the overall, our portfolio was able to generate a more meaningful, was more profitable this year with the higher ADR. And so it was adjusting based on what was going on in the market. What I'll say is, and this is true with all the other markets that we're going to be talking about, there's been a lot of volatility. So things have been up and down, and we've really had to kind of adjust the ADR, the rate to balance the ADR and the occupancy. And so you see, you know, January, well, end of year, December 2024 was kind of a killer, right? And so we went into the year with kind of exuberance, and especially with the new administration coming in, I think there was a lot of exuberance about kind of a pro-business environment, and that kind of carried through into January. But then, as you can see, that April dip, at least on our end, we did see that, and we kind of missed a little bit on April, but then kind of picked back up. And so it's all a lot of volatility, but with all that, we were still able to kind of adjust along the way to keep things moving smoothly. going through kind of the booking window and how Melanie was talking about, the booking window is really shrinking. Um, what we are seeing is that what these graphs show is on the top are the number of nights booked in the last 30 days. And on the bottom is for the market, what was booked in the last 30 days. So what we are seeing in our portfolio is that it's kind of the 1 to 2 month period, and this is Hawaii, so people do plan, but that's kind of where the majority of all the bookings are coming in, and all the higher value bookings are coming in. We do get a little further out and a little closer in, but we really try to be fairly fully booked by the time we're in the last 2 weeks in, and so trying to keep that low. One of the ways that we think of booking windows and bookings is that it's kind of like a time conveyor belt. And so there's a little bit of bookings that you want to get far out. And then by the time you get in close, there's actually limited availability on your calendar. Um, what we're doing is slightly different from what the overall market is doing, right? So obviously the market has a lot more properties, so that's why. But there's kind of this bump up 2 to 4 months out, bump up 2 to 4 weeks out, and then within a week there's a kind of a bump up. And so what we are trying to do is adjust the 1 to 2 month out, get a lot of the bookings there to minimize what we need to kind of fill in last minute. So as you're looking out into the future, um, how we are kind of informing our decisions is when this graph, the red line shows the occupancy of the market um, at this point in time today. And then the dotted line shows the occupancy of the market at the same time last year. So if the red line is below last year, it means you're pacing behind. If the market is pacing behind, and if the red line is above the dotted line, that means it's pacing ahead. What you see is for the rest of the summer, for June and then most of, or I guess the first part of July, the occupancy actually is pacing behind. So this would not be a good time to be trying to get the maximum revenue, ADR, and rather trying to get more occupancy filled in. But you see the volatility, it's kind of up and down, up and down. And so you can kind of use this as a guide to set your conveyor belt of like when you want to try to attract the occupancy. I'll go a little faster on the next two markets. The next is in the Smoky Mountains. We're looking at Pigeon Forge and Gatlinburg. Again, we're looking at two-bedroom cabins. And here, what we're seeing is last year's occupancy, the market was at 55. This year, for this portfolio, last year was at 66. This year, it's at 52, and the market is at, as of now, the portfolio is at 62%. Sorry for mixing up my words. But both times, the portfolio has had a higher occupancy than the rest of the market over that period of time. So what we're doing again, last year, the ADR was slightly behind the market average overall, right? About $8 behind. And this year, we're also behind in terms of ADR. But balancing that through, on the RevPAR basis, the market has gone down from 115 to 104. And this portfolio also went down, but has been able to continue to beat the market. And again, it's finding that balance between the ADR and the occupancy. Melanie had said how, high occupancy is not necessarily what you want to achieve. We are achieving a higher occupancy, but obviously in this market, 100% occupancy is pretty challenging to achieve. Looking at book nights within the last 30 days, again, in this market, we're seeing kind of for our portfolio, kind of 2 to 4 weeks out is the predominant booking window. But we do see strong bookings between 1 week to 2 weeks out, as well as 1 to 2 months out. Moving forward, we probably will want to push this out a little bit and get some more 2 to 4 months out. But this is just all within the 30 days. This is not to say that we don't have any bookings 2 to 4 months out. Uh, and then on the market, what we are seeing is the 1 to 2 months out is kind of that predominant range. But again, we're we're filling in most of the occupancy the prior to the 1 day out. And so we're trying to limit how much we're getting at the last minute. And that's kind of a controlled process that we're looking at. And again, for the immediate summer, the Smoky Mountains is pacing slightly behind. But then as we're looking out into the future, it's pacing more or less the same as last year and then slightly outperforming towards the end of the year, meaning you may want to keep your rates a little bit lower here, and then recall back to what your rates were last year, late summer and into the fall, and possibly that may get you the performance that you want. And then the last market is Pompano Beach, Florida. Um, I'll just kind of go through this quickly. This is a client of ours who actually really wants to maximize occupancy. And so that's why you're seeing, 95% occupancy both last year and this year. And, very similar for the market is that at 71%, so staying flat in terms of occupancy. Um, this market has declined in terms of ADR. So last year the market was at 301. This year it went to 287. What we were able to do, however, was go from 237 to 245 in terms of the average daily rate, meaning in a declining market, we were able to kind of increase the overall revenue for this portfolio. Again, we were focusing highly on making sure that as few nights went unbooked as possible, and that was the preference of the owner who really you know couldn't stand to see a night go unbooked. And so then now you see again the booking window. Um, we're trying to get some far out bookings, but we do have more close-in bookings coming in, aligning with this property owner's preferences. But the market as a whole kind of has, kind of 1 to 2 month out, and then a lot of last minute 1 day bookings. So that's kind of the market that this is in. So we are kind of limiting, that last minute dropped rate to fill the rest of the occupancy. If you're looking at the pacing report, this market is pacing noticeably behind last year. And so with that, it's probably looking forward not a good idea to try to hope for what happened last year and rather switch over to kind of being a little bit more nimble. So that's what I have, and I just wanted to kind of talk through the three different markets and kind of the differences and what we're seeing and how things are kind of turning out for the rest of the year. And so I will stop here, but if anyone would like to talk about their portfolio and revenue management, you can either scan this QR code or schedule a call with us. And we do have a 6 month discounted rate for anyone who signs up from this webinar. So let me stop sharing.
Thanks so much, Sean. Lots of great information, and obviously very detailed look right at what everyone needs to keep in mind. And I'm hoping we'll have some questions. Just a reminder to everyone, if you have any questions, to go ahead and put them in the chat. I have one question right off the bat, just relevant to small businesses who are juggling a lot of different things, right? I'm wondering how often you recommend sitting down and actually taking a look at some of these metrics to incorporate any insights into their strategy. Is that something people need to be doing weekly, monthly?
Melanie, do you want to go first or should I?
I'm happy to take it. I mean, there's not a hard and fast rule, right? It's going to depend on how dynamic your market is. And then also who you have on your team, right? If you are a one-man band with 30 properties, you're going to have less time to kind of dive into this data than somebody with a full-time designated revenue manager. I'd say minimum getting your data once a week. See what you booked over the past 7 days, see what you still have open and make some tweaks. You should be changing prices pretty frequently. Again, at least once a week is kind of the best rule of thumb that we like to tell people. And then if you are like data obsessed like I am, maybe you wake up and look at your data every morning with a cup of coffee, instead of the newspaper. We'll see which one's scarier and see where you might be able to make some actions. John, would love to hear your perspective though, because I'm sure it's different than mine.
Well, there's definitely kind of a frequency based on your interest and, kind of what you want to achieve. What I would say is big level market data is not going to shift very dramatically from, you know, week to week. It's typically kind of on a month-to-month basis that you actually see kind of at a big level what the market is doing. So kind of depending on what the data is, like what your market is doing, maybe every 2 weeks, again, there's no hard and fast rule, but every 2 weeks to kind of a month is, again, if you're kind of a solopreneur, that should be adequate. Um, in terms of going in and seeing how your property is doing and making those adjustments, we touch every property at least twice a week. And so what we don't do every day intentionally because again, that's too frequent. There's not enough time for um, the market or the customers, the guests to see that change and make the bookings. So doing it every day is almost like driving and having your hand like really tight on the wheel and like not having a smooth ride. Uh, at the same time, if you're waiting like a month or two and then going in and changing it, that's like swerving because like you're about to hit a tree or something because you weren't paying attention. So if you go like, once a week to twice a week, there's enough time for things to kind of adjust. You see what's going on. And then again, using that driving analogy, it's like making that like tiny little adjustment to the steering wheel so you're staying on the road and like not hitting anything without like constantly, fiddling with the wheel. So that's kind of the cadence and pace that we've come to. When I personally started with my own portfolio, I think 8 or 9 years ago, I used to think I had to go in every day and like I spent an hour every day on revenue management. And then I realized actually that was overkill and that was actually counterproductive.
It's good to hear that that's not helpful or recommended because I think most people also just probably don't have the time,
I
right?
hear you again. I don't know what's going on.
Oh no. Can you hear me, Melanie?
Please go on
I
with
can,
Melanie. I'll try to figure out what's going on with my audio.
Can you hear me, Melanie?
I can,
Again?
yes.
Okay, good. Um, well, I'll read out the next question, and maybe you can repeat it for John, since I think he can hear you. Um, our
I
next
can hear now.
question. Okay, sweet. Our next question comes from Liana, and it's: would launching a new Airbnb be a bad idea in a slow season? I'm not sure to what point you guys will be able to speak to this, but do you have any thoughts?
I'll
John, you
take
want
a
to go
stab at
first?
this.
Yeah.
Um, Revenue management is not a point in time, it's a process that happens over time. So it's like a flywheel, right? It takes a lot of effort to initially get it going, but if you get into that routine, it starts getting going. So to me, if you're gonna run a short-term rental, you start it when you can start it. And you're not only looking at the immediate future, but you're also looking, 3, 6, 9, 12 months out ahead. And so you're looking at that, peak season that's coming up while you're trying to get it going. And so if you could start getting that property going, in the immediate term, even if it's during a low season, that gives you that momentum. So by the time you get to the peak season, everything's rolling. So from my point of view, I would say it's a great idea to get it started as soon as you can because you're going to need that runway.
Okay.
I
Jen,
agree with that. Great time to iron out all the kinks, right? And get those set for peak season. Um, I'd say cash flow is probably a consideration though there. Like, can you bankroll the operation for a few weeks or a few months with low bookings to get yourself to that peak season is certainly a consideration there.
that's a good
Yeah,
point. But
especially
yeah,
in like a hot market where like the AC needs to be running, I think that comes into play. If you're kind of in a mild location, typically the operating costs end up being you need a cleaner, but then if you're getting a cleaning fee, that should cover it, right? So even if you're operating, and this, a lot of people will disagree with me on this, but even if you're operating at a nightly loss, right? Like if you calculated, here's my fixed cost and I divide it by 30 days. So my daily minimum nut is, let's say, $200. Even if you're bringing in $150 a night, getting that going and you're bringing in more than just sitting empty. And so, especially when you're trying to get going, being a little bit flexible on that like bottom line dollar and just, cover some of your costs rather than none of your cost.
For sure, yeah. And I was going to say also just like operationally, starting in high season, being a brand new host probably isn't a great idea unless you really know what you're doing right off the bat, right? Because you're going to have um, a lot of things to kind of smooth out as you get started, I'm sure.
I don't know why I can't hear you. I'm having technical difficulties.
Oh no, well, we're about at the hour, so maybe you can communicate that, Melanie. Sorry, we're about at the hour, so don't worry too much about that.
Yeah, John, Mikkel was saying it's, just a good time to not start in the peak season because things will go wrong. But we're almost at the hour, so we're getting there anyway.
Yeah. I did have one last question if we want to end on it. I'm just curious, when hosts do see that demand is taking a dip, do you have any recommendations other than like starting the race to the bottom with pricing decreases? Is there anything else hosts can do before just, making those massive decreases? Maybe you can answer and then repeat the question to John, Melanie.
Yeah. So, John, the question was, if demand starts to dip, is there anything to do other than race to the bottom with prices? The good news is there's a lot of stuff to do other than price. I would say, keep an eye on your marketing and your distribution. So, usually, one segment may be declining, international travel, for example, but a lot of times another segment like drive to stays pretty healthy. And so if you're doing, some marketing email ads, like you can change the way you're phrasing that. You can start to cater more to those drive to people. If you're in a destination that can be driven to, you can take a look at stay length and booking windows and like try to make sure you're getting in front of the consumers at the right time. Start to adjust some of those stay length restrictions if you haven't already at that time. And then last thing would be, again, take a look at your channel distribution, right? So maybe fewer people are booking, but how can you get your properties in front of more eyes? So it might be a good time to start listing on Vrbo if you're only on Airbnb, or start to explore, booking.com or some of the smaller channels out there as well. Just to make sure you're getting as many eyes on your unit as possible. But John, would love to hear your perspective.
Yeah, everything that you said, Melanie, it's not just the pricing. One thing, you can coordinate your promotions with your price. So, you're getting more visibility at about the same price, the old trick of raise your price and then put the promotion and get that. The other thing that I'll say is it's really not tanking the price, right? So one thing is, again, look at your further out dates so you're not constantly in this situation of low demand while you're trying to fix what's going on. So don't just focus on that immediate 30 days out. In terms of channel distribution, you can use the different channels differently. So for example, you can discount on Airbnb, for example, right? And maybe go a lower rate. But then VRBO, Booking.com, and other channels, you can kind of balance that out so that if you get a booking from Booking.com, it's actually a good price booking, while Airbnb's there to kind of fill it in, or your direct booking. So kind of figuring out a strategy for how you want to use the different channels. Um, Lots of different ways, but everything that Melanie said, definitely true. But think about like, how can I strategically increase my opportunity to get booked, and it doesn't mean that all has to be at the, rock bottom price across all the channels. Um, yeah, I'll leave it at that.
Awesome. Thank you both so much. That definitely makes a lot of sense. And it's good to know in a market where, we're still trying to keep our revenue as high as possible. There are other options. Um, so yeah, thank you both so much for your presentations. Is there anything else you want to add before we wrap up?
No, that was great. Thank you for hosting, Mikkel, and John, lovely to present with you today.
Thank you both. Had a great time.
Awesome. Thank you. Well, everyone will be sending out the recording tomorrow, so keep an eye on your email and have a great rest of your day. All right. Bye.
Bye.